Let me ask you a question that will change how you think about building wealth. What if you woke up tomorrow with nothing? No savings, no investments, no portfolio, no safety net, just the knowledge inside your head and 12 months to rebuild everything. What would you do? Most people would panic. They would feel hopeless, defeated, overwhelmed by the magnitude of starting over from zero. But I want to tell you something that might surprise you. If that happened to me tomorrow, if every dollar I had disappeared overnight, I would not be worried. I would be excited, because I know exactly what I would do. I know the exact steps I would take to rebuild wealth in 12 months. And today, I am going to share those steps with you now. I know what some of you are thinking. Easy for you to say. You have connections, you have experience, you have a reputation that opens doors, and that is fair. But here is the truth that most people never realize. The principles that create wealth work at every level. The strategies I would use to rebuild from nothing are the exact same strategies that work whether you are starting with $1,000 or $100,000. The scale changes, but the fundamentals do not. Let me tell you a story that shaped how I think about this. Back in 1992, I started my first fund with just $3 million from a handful of investors. By today's standards, that might not sound like nothing. But in the hedge fund world, it was essentially starting from scratch. Most funds at the time needed 50 million, 100 million to be taken seriously. I had 3 million and a small office that I could barely afford. Within 2 years, that fund had grown to over $400 million. Not because I got lucky, not because markets went up, but because I applied principles that work regardless of how much capital you have. The most important lesson I learned during that period was this. Building wealth is not about finding some magical investment or getting some hot tip or being in the right place at the right time. Building wealth is a systematic process. It is about making the right decisions consistently, avoiding catastrophic mistakes, and letting time and compound interest do the heavy work. If you understand this, if you truly internalize this, you can build wealth from any starting point. I am going to share with you the exact framework I would follow if I had to stop from zero in 2020. 6 with nothing but 12 months to rebuild. This is not theoretical. These are the specific, actionable steps I would take. In the exact order I would take them. And by the end of this, you will have a complete blueprint for building wealth quickly and sustainably, regardless of where you are starting from. Before I reveal the specific steps, let me tell you why starting over in 2026 is actually better than starting over at almost any other point in history. We are living in a unique moment. Interest rates have normalized, which means money has real value again. Artificial intelligence is creating opportunities that did not exist even 2 years ago. The market has experienced enough volatility that bargains exist. And most importantly, the tools available to individual investors today, the information, the platforms, the access, would have been unimaginable when I started in this business. When I began my career, getting real-time stock quotes required expensive subscriptions. Researching a company meant requesting annual reports by mail and waiting weeks for them to arrive. Executing a trade cost hundreds of dollars in commissions. Today, you can access more information on your phone than professional investors had in their entire offices 30 years ago. You can trade for essentially free. You can invest in fractional shares with as little as $1. The democratization of investing is real, and it creates opportunities for anyone willing to learn and execute. But here's what most people get wrong. They think that access to tools and information is enough. It is not. The tools only matter if you know how to use them. The information only matters if you know what to do with it. And that is what separates people who build wealth from people who lose money. Not access, but knowledge applied correctly. Let me walk you through the framework I would use. The first thing I would do, and this might surprise you, is not invest a single dollar. Instead, I would spend the first 30 days building what I call an emergency fortress. Most people, when they think about building wealth, immediately think about investing. They want to know which stocks to buy, which sectors to bet on, which opportunities to pursue. But that is completely backwards. Before you can build wealth, you must protect yourself from destruction. The number one reason people fail to build wealth is not bad investments. It is unexpected expenses that force them to liquidate positions at the worst possible time. Think about what happened during the 2020 market crash. The S&P 500 dropped 34% in just 23 trading days. Millions of people panic sold at the bottom, but within 5 months, the market had completely recovered and went on to new highs. The people who sold at the bottom locked in massive losses. The people who held, or better yet, bought more during the crash, made fortunes. What was the difference? The people who sold needed the money. They did not have an emergency fortress. They were forced sellers. So before I invest anything, I would build a cash reserve of at least 3 months of living expenses. Now, I know that sounds boring. I know that sounds slow, but it is absolutely essential. This cash is not an investment. It is insurance. It is what allows you to stay invested when markets crash. It is what keeps you from being a forced seller. It is the foundation that makes everything else possible. I would keep this emergency fund in a high-yield savings account or short-term treasury bills. Right now, you can earn over 4% on completely safe money. That is not nothing. And more importantly, that money is available instantly if you need it. No penalties, no waiting, no market risk. Here is the key insight that most people miss. The emergency fund is not just about the money, it is about the psychology. When you know you have 3 months of expenses covered, you can think long-term, you can make investment decisions based on fundamentals rather than fear. You can hold through volatility instead of panic selling. That psychological security is worth more than any investment return. Now, some of you might be thinking, but I want to start investing immediately. I do not want to wait 30 days. I understand that impulse, but I am telling you from decades of experience that skipping this step is one of the most common and costly mistakes investors make. I have seen brilliant investors blow themselves up because they did not have adequate reserves when crisis hit. I have seen people forced to sell stocks at 50% losses because they needed cash for an unexpected expense. Do not be that person. Build the fortress first. The second thing I would do, once I have my emergency fund in place, is eliminate all high-interest debt. This is another step that people want to skip because it does not feel like building wealth. But mathematically, it is one of the highest return investments you can make. Let me explain the math. If you have credit card debt at 20% interest, every dollar you put toward that debt earns you an immediate, guaranteed, risk-free 20% return. There is no investment in the world that offers a guaranteed 20% return. The stock market has historically returned about 10% annually. Real estate maybe 7 to 8%, bonds even less. But paying off high-interest debt gives you an immediate return equal to the interest rate, with zero risk. It is the best deal in finance. I learned this lesson early in my career when I was working with distressed companies over and over. I saw businesses that were fundamentally sound get destroyed by their debt load. It was not that their products were bad or their management was incompetent. It was that the interest payments consumed all their cash flow, leaving nothing for investment and growth. The same principle applies to personal finance. Debt is a cancer that eats away at your ability to build wealth. Now, I am not talking about all debt, mortgage debt at 4 or 5% interest. That is a different calculation. You can make a reasonable argument for carrying that debt and investing the difference. But credit card debt, personal loans at high rates, those have to go. They have to go before you invest another dollar in the stock market. Here is how I would prioritize it. List all your debts from highest interest rate to lowest. Make minimum payments on everything except the highest rate debt. Put every extra dollar toward that highest rate debt until it is gone. Then move to the next highest rate. This is called the avalanche method, and mathematically it saves you the most money. Some people prefer the snowball method, where you pay off the smallest balances first for psychological wins. That is fine too. The important thing is that you have a plan and you execute it systematically. I would give myself 60 to 90 days to eliminate high interest debt, depending on how much I was starting with. Again, this might feel slow, It might feel like you are not making progress on your wealth building goals, but trust me, eliminating this debt is building wealth. Every dollar of interest you no longer pay is a dollar that can compound in your favor instead of compounding against you. The third step, and this is where the real wealth building begins, is to start investing in what I call the foundation portfolio. This is not about picking stocks or timing markets or finding the next hot trend. This is about building a base of investments that will grow steadily over time with minimal effort and minimal risk. If I were starting from scratch in 2026, I would put at least 50% of my investment capital into a simple, low-cost index fund that tracks the S&P 500 or the total U.S. stock market. I would do this through dollar cost averaging, investing the same amount every week or every 2 weeks, regardless of what the market is doing. Let me explain why this works. The S&P 500 represents ownership in the 500 largest and most profitable companies in America. When you buy an index fund, you are buying a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and every other major American company. These companies have survived world wars, recessions, depressions, pandemics, and every other crisis imaginable. They will almost certainly survive whatever challenges the future brings. Historically, the S&P 500 has returned about 10% per year over long periods. Some years it is up 20 or 30%. Some years it is down 20% or more. But over decades, that 10% average holds remarkably steady. And because of compound interest, those returns become extraordinary over time. Let me show you the math that changed my life when I first understood it. If you invest $500 per month at 10% annual returns, after 10 years you have about $100,000. After 20 years, you have about $340,000. After 30 years, you have over $1 million. And remember, you only invested $180,000 of your own money. The rest, over $800,000, came from compound returns on your investments. This is why I call it the foundation portfolio. It is not exciting. It is not going to double overnight, but it is virtually guaranteed to build significant wealth over time, and it requires almost no effort. You set up automatic investments and forget about them. You do not check the market every day. You do not panic when prices drop. You just keep investing systematically and let compound interest work its magic. Now I know some of you are thinking, but I want to beat the market. I want higher returns. I want to find the next big winner, and I understand that impulse. We will get to that in a moment. But here is what I want you to understand first. Most professional investors, people who do this full-time with billion-dollar research budgets, fail to beat the index over long periods. More than 90% of actively managed funds underperform the S&P 500 over 15-year periods. If the professionals cannot beat the index, what makes you think you can? I say this not to discourage you, but to give you a realistic framework. The foundation portfolio is not about being average. It is about capturing the extraordinary returns of American capitalism with minimal effort and minimal risk. It is about ensuring that no matter what happens with your other investments, you have a solid base that will grow over time. The fourth step in my framework is what I call strategic concentration. This is where we move beyond the foundation portfolio and start looking for opportunities to generate above-market returns. But I want to be very clear about something. This is where most people get into trouble. This is where the ego kicks in, where people start thinking they are smarter than the market, where fortunes are lost as quickly as they are made. If I were starting from scratch, I would allocate no more than 30% of my portfolio to individual stocks or concentrated positions. The other 70% stays in the foundation portfolio, safe and growing steadily. This 30% is where I can try to add alpha to generate returns above what the market gives for free. But I limit it to 30% because I know that even with decades of experience, I will be wrong sometimes. The concentrated positions should never be so large that being wrong destroys you. Within this 30% allocation, I would focus on what I know best. Companies with strong competitive moats, meaning sustainable advantages that protect them from competition. Companies with pricing power, meaning they can raise prices without losing customers. companies with strong balance sheets, meaning little debt and lots of cash, and companies trading at reasonable valuations, meaning I am not paying 50 times earnings for a business that grows at 10%. But they give you a specific example of how I think about this. When I look at a company, I ask myself one simple question: will this business be larger, more profitable, and more dominant 10 years from now than it is today? If the answer is clearly yes, and the price is reasonable, that is a potential investment. If the answer is unclear, or if the price already reflects decades of perfect execution, I move on. I would also focus on sectors I understand deeply. For me, that is real estate, financial services, and certain consumer businesses. I have spent decades analyzing these industries. I understand their dynamics, their risks, their opportunities. When I invest in something, I understand, I have conviction. When I have conviction, I can hold through volatility instead of panic selling at the bottom. This is perhaps the most important point I can make about individual stock investing. You must invest in what you understand. If you do not understand a business well enough to explain it to a child, you do not understand it well enough to invest in it. This eliminates most stocks from consideration, and that is fine. You do not need to invest in everything. You need to invest in a few things you understand deeply and well. The fifth step, and this is crucial for anyone over 50, is income generation. If I were starting over at this stage of life, I would make sure that a portion of my portfolio generates regular income, not just growth. There are two reasons for this. First, income provides psychological comfort. When you see dividends and interest payments hitting your account every month or every quarter, it reinforces that your investments are working for you. This makes it easier to hold through market volatility. Second, income can be reinvested during your accumulation years, accelerating your wealth building, and then transition to living expenses when you need it. For income generation, I would focus on three categories. First, dividend-paying stocks. These are typically mature, profitable companies that return cash to shareholders. Think utilities, consumer staples, established technology companies. The best dividend payers have long track records of increasing their dividends every year. Some companies have raised their dividends for 50 consecutive years or more. That kind of consistency tells you something about the quality of the business. Second, I would look at real estate investment trusts or REITs. These are companies that own income, producing properties like apartments, office buildings, shopping centers, and warehouses. By law, they must distribute at least 90% of their taxable income to shareholders as dividends. This means they typically offer higher yields than regular stocks. Some REITs currently yield 6, 7, even 8%. Third, I would consider bonds and bond funds, but only high-quality ones. With interest rates where they are now, you can earn 4 to 5% on investment. Grade corporate bonds with very little risk. This is a dramatic change from just a few years ago when bonds paid almost nothing. For the income portion of a portfolio high quality, bonds provide stability and predictable returns. I would allocate about 20% of my portfolio to income, generating investments. This might seem high to some, but I believe the psychological benefits and the compounding power of reinvested dividends make it worthwhile. And as I get closer to needing the money, I can simply stop reinvesting and let the income flow to my bank account for living expenses. The sixth and final step in my framework is what I call asymmetric bets. These are investments where the potential upside dramatically outweighs the potential downside. They are risky, and most of them will not work. But the ones that do work can generate returns that transform your entire financial picture. Now, I want to be extremely careful here. Asymmetric bets should be a tiny portion of your portfolio. I would allocate no more than 10%, and honestly, 5% is probably enough. This is money you can afford to lose completely. If losing this money would cause you financial distress, you should not make these bets. What qualifies as an asymmetric bet situations, where a small amount of capital could potentially multiply many times over if things go right. This could be a deeply undervalued stock that the market has given up on. It could be a new technology or business model that has the potential to disrupt an entire industry. It could be option strategies that offer defined risk with unlimited upside. Let me give you an example from my own experience. In 2011, I began building a position in a company that had been beaten down because of accounting questions and short seller attacks. The stock had fallen from $30 to about $10. Most people had given up on it. But when I analyzed the business, I saw that the underlying fundamentals were sound. The accounting issues were technical, not fraudulent. And if the company survived the crisis, the stock had enormous upside potential. I sized the position appropriately, knowing that I could be wrong. The investment was structured so that if I was wrong, I would lose money, but it would not destroy me. And if I was right, the returns would be significant enough to matter. Over the next several years, that investment multiplied more than 6 times. One position sized correctly generated returns that would have taken decades to achieve in an index fund. But here is the key. I made that bet with capital I could afford to lose. I had the foundation portfolio generating steady returns. I had the emergency fund providing security. I had income investments generating cash flow. The asymmetric bet was the cherry on top, not the foundation. That is the proper way to think about risky investments. They are opportunities to accelerate wealth building if things go well, not desperate gambles that you need to work out. If you find yourself needing your risky bets to succeed, you have the proportion wrong. Let me bring all of this together and show you exactly what my portfolio would look like 12 months after starting from zero. Month 1 through 3 would be dedicated to building the emergency fund and eliminating high-interest debt. No investments yet, just laying the foundation. Months 4 through 6, I would begin building the foundation portfolio with regular, automatic investments into low-cost index funds. At the same time, I would continue paying down any remaining debt. Months 7 through 9, as my foundation portfolio grows, I would begin allocating to income investments, dividend stocks, REITs, high-quality bonds. Still nothing aggressive, just building a diversified base. Months 10 through 12, with the foundation solid, I would begin looking at individual stocks for my concentrated positions. Taking my time, being selective, only investing in companies I truly understand. And somewhere in this 12-month period, if I encountered a genuine asymmetric opportunity, I might make a small bet with money I could afford to lose. At the end of 12 months, my portfolio would look something like this: 50% in index funds, 20% in income, generating investments, 25% in carefully selected individual stocks, and 5% in asymmetric opportunities. This allocation would evolve over time as I got older, shifting more toward income and away from growth. But for rebuilding in year 1, this is the framework I would follow. Now, let me address something important. Everything I have described assumes you are doing this in tax-advantaged accounts to the maximum extent possible. If you have access to a 401k with employer matching, that is free money, take it. Every dollar your employer matches is an immediate 100% return. There's nothing in the investment world that offers those kinds of guaranteed returns. After maxing out your 401k match, I would focus on a Roth IRA if you qualify. Roth accounts grow tax-free and can be withdrawn tax-free in retirement, for younger investors especially. Decades of tax-free growth is extraordinarily valuable. Only after maximizing tax-advantaged accounts would I invest in regular taxable brokerage accounts. The tax benefits of retirement accounts are so significant that they should almost always come first. I want to share one more principle that ties everything together. The most important factor in building wealth is not which stocks you pick or which asset allocation you choose. It is your savings rate. How much of your income do you actually invest? I have seen people with modest incomes build significant wealth because they saved and invested 40 or 50% of everything they earned. I have also seen people with high incomes who retired with almost nothing because they spent everything and saved nothing. The math is simple. If you save 10% of your income, you must work 9 years for every 1 year of retirement you want to fund. If you save 50% of your income, you only need to work 1 year for every 1 year of retirement. If I were starting from scratch and truly committed to building wealth in 12 months, I would ruthlessly cut expenses and maximize savings. I would question every purchase. I would eliminate subscriptions I do not use. I would find ways to reduce housing costs, transportation costs, food costs, not to live a miserable life, but to create the maximum possible gap between what I earn and what I spend. That gap is the raw material of wealth. Let me leave you with this thought. Starting from nothing is not a disadvantage. It is a clarifying force. When you have nothing, you cannot rely on the cushion of existing wealth to cover up bad decisions. Every choice matters. Every dollar counts. Every decision has consequences. I started with very little. I built something significant. Not because I was smarter than everyone else, but because I understood these principles and applied them consistently over time. You can do the same thing. Anyone can do the same thing. The principles do not care about your background, your education, your connections, or your starting point. They work for everyone who applies them. If you are watching this and feeling overwhelmed, feeling like the task is too big, feeling like you cannot possibly build wealth from where you are starting, I want you to remember one thing. Every fortune ever built started from nothing. Every successful investor had a moment where they were beginners, where they knew nothing, where they had no capital to invest. The difference is they started anyway. They took the first step. They built the emergency fund. They paid off the debt. They made the first investment. And they kept going, day after day, month after month, year after year, until the results became undeniable. The 12-month framework I have given you is not a get-rich, quick scheme. It is the beginning of a process that will unfold over years and decades. But it is a start. And starting is the only thing that matters. Everything else, the compound interest, the portfolio growth, the financial independence, all of that flows from the simple decision to begin. 2026 is a year of opportunity. The tools are available. The knowledge is accessible. The path is clear. The only question is whether you will take it. I hope you will. I believe you can. And I know that if you follow these principles consistently, you will build something meaningful. Not just money, but security. Not just wealth, but freedom. Not just a portfolio, but a life where your financial future is in your own hands. That is what building wealth is really about. Not the numbers on a screen, but the options those numbers create. The ability to say no to things that do not serve you. The ability to say yes to opportunities that excite you. The ability to weather storms without panic. The ability to help others when they need it. The ability to live life on your own terms. I want to share something that took me years to understand. The reason most people fail to build wealth has nothing to do with knowledge. The information I have shared today is available in countless books, videos, and articles. The principles are not secret. Compound interest is not a new discovery. Index funds have been around for 50 years, so why do so few people actually build significant wealth? The answer is execution. The gap between knowing and doing is where most people fail. They know they should save more. They do not. They know they should invest consistently. They do not. They know they should avoid high-interest debt. They take on more anyway. They know they should hold through market volatility. They panic sell at the bottom. Knowledge without execution is worthless. Execution without consistency is futile. The magic happens when you combine knowledge, execution, and consistency over long periods of time. That is the entire secret of wealth building in one sentence. Let me tell you about a study that changed how I think about investor behavior. Researchers looked at the returns of mutual fund investors versus the returns of the funds themselves. What they found was stunning. The average investor in equity mutual funds earned about 4% less per year than the funds they invested in. 4% per year. How is that possible? How can you earn less than the fund you own? The answer is behavior. Investors tend to buy after funds have performed well, chasing performance. They tend to sell after funds have performed poorly, fleeing losses. This buy high, sell low behavior destroys returns. The fund itself might return 10%, but the average investor in that fund earns 6% because of their own poor timing decisions. This is why the framework I have described emphasizes automation and consistency. When you set up automatic investments, you remove the temptation to time the market. You buy every week or every 2 weeks regardless of what the market is doing. Sometimes you buy high, sometimes you buy low. Over time, you get the average. And the average, without the behavioral mistakes that plague most investors, beats what most people actually achieve. I also want to address a common objection I hear. People say they will start investing once they earn more money. Once they get that promotion, once they pay off their car, once their kids finish school, always once something else happens first. But here is the truth. If you cannot save and invest on your current income, you will not save and invest on a higher income. Lifestyle inflation is real. When people earn more, they spend more. The only way to break this cycle is to start investing now, with whatever amount you can, and make it automatic. So it happens before you have a chance to spend the money on something else. Even $50 per month matters. That might seem insignificant compared to the wealth you want to build. But $50 per month invested consistently for 40 years at 10% returns becomes nearly $300,000. That is the power of starting early and staying consistent. The amounts grow as your income grows, but the habit must start now. I want to speak specifically to those watching who feel they have started too late. Maybe you are in your 50s or 60s. Maybe you feel like the opportunity has passed. I want to tell you something important. It is not too late. Yes, you have less time for compound interest to work. Yes, you will need to save more aggressively. Yes, you might need to adjust your expectations. But the principles still work. Building wealth in your 50s or 60s is absolutely possible if you commit to the process. The biggest mistake late starters make is trying to catch up by taking excessive risk. They feel behind. So they put everything into speculative investments hoping to hit a home run. This is exactly backwards. When you have less time, you have less ability to recover from losses. A 30-year-old can survive a 50% market crash and wait for recovery. A 60-year-old who needs the money in 5 years cannot afford that risk. If you are starting late, focus on the fundamentals even more intensely. Maximize your savings rate. Take full advantage of catch-up contributions to retirement accounts. Build a diversified portfolio weighted more toward income and stability. Accept that your path might look different than someone who started at 25, but know that meaningful wealth building is still possible. The other group I want to address is young people who think they have plenty of time. Yes, you have the extraordinary advantage of decades for compound interest to work, but that advantage only materializes if you actually use it. I have seen too many young people assume they will start investing later and waste years of potential growth. Every year you delay is a year of compounding you will never get back. If you are in your 20s, even small amounts invested now will grow to significant sums by retirement. $100 per month starting at age 25 becomes over $600,000 by age 65 at historical market returns. The same $100 per month starting at age 35 becomes only about $220,000. 10 years of delayed start costs you almost $400,000. Let me bring this back to the central question. If you had to start from nothing in 2026, what would you do? I have given you the framework. Emergency fund first. Eliminate high-interest debt second. Foundation portfolio third. Income investments fourth. Concentrated positions fifth. Asymmetric bets sixth and last. This sequence matters. Skipping steps or reordering them is how people get into trouble. But beyond the framework, I want you to understand the mindset that makes wealth building possible. It is not about deprivation or sacrifice. It is about intentionality, knowing what you value and directing your resources toward those things, knowing what does not matter to you, and ruthlessly cutting spending in those areas. Building a life where financial stress does not dictate your decisions. Start today, build the foundation, execute the plan, and in 12 months you will look back at this moment as the turning point. The moment when everything changed, the moment when you decided to take control. That is what I would do if I had to start from nothing. And that is what I am confident you can do too.